having me back. I was joking that every year when I come here, I always promise Kelvin that I will stay to ski and I will get my slides done early. And I failed on both accounts because there's no snow, so I can't ski. And I did not get my slides done early because there's a little war going on, and so that's made everything a bit up in the air. And so while I did make too many slides as usual, I'm going to move through them fairly quickly because I did want to leave some time at the end if people have questions or to talk about anything that's going on, because obviously it's a pretty fluid situation geopolitically, and that has an impact on markets. But I'll spend the bulk of the time kind of hitting on what we've got here. I want to talk a little bit about what happened in 2025. I'll do that pretty quickly. Just a few takeaways that I think are important. I'll talk a little bit about what we expect to happen through the rest of 2026. And then I really want to spend the bulk of the time just sharing with you some of the questions that I get from clients when I go out on the road and I do a lot of these events. And that's, I think, important because it tells you what are people worried about, what are they thinking about, how are they adjusting portfolios. And as you heard from Glade, I spend most of my time working with large families all over the world, helping them manage investments. And I work with about 700 of them globally from a variety of different industries and backgrounds. All right, so let's just jump into a little bit about what happened in 2025. There's a lot going on in this bar chart, and by the way, we'll make these slides available, so if you can't read everything, I'll do my best to explain them, but we'll send them out if you guys want them. Big takeaway, it was actually a really good year for equity markets. When I was here last year, I talked a bit that I thought we'd end the year higher than we began. We did. But in spite of having what I would call a very strong year for the US is actually one of the worst performers if you look globally. What these bars are showing you is the returns for everything in 2025. And in fact, when you look at the US equity market, it was only up 18%. And in fact, every other developed market, Europe, Asia, Japan, performed better and significantly better. And then you had things like gold up over 60%. And so I want to put that 18% in context. In any given year, we think you're going to get 7 to 8% from US stocks. So by being up 18, that was more than double what we expect, but again, underperformed, because this big trend that we saw last year was money moving from the US to other parts of the world. As investors said, you know what, I'm worried about US debt, I'm worried about some of the things the new administration is talking about, I think I might be able to make more money somewhere else, and in fact, that's actually what happened. The other big standout here is gold. It's very rare to see gold, which is generally perceived to be a safe haven or where people go when they're nervous, perform this well, up 60%, but then see other risk assets like stocks, up 15, 20%. And so it's a kind of strange dichotomy where people are nervous, so they're buying gold, but then they're actually still making really strong returns in equity markets. The other thing I would say, again, just talking about the US, up 18%. This is the third year in a row you've had double-digit returns. And in fact, since 2022, US stocks have returned 75% since those lows that we saw in the fall of 22. So it's actually just been like an amazing run for risk assets. And I mention that because fast forward to where we are now, and I'll talk a little bit about what's happening this year, obviously a lot more volatility, but it's coming on the back of this huge rally. And so you want to kind of keep that in context. I think the only other thing, let me go back one. The only thing I would just mention about what happened in 2025, big concerns, the chart on the right is inflation. Around will inflation actually start to come down and will it start to moderate? And it's not where the Fed wants it to be. They talk about a 2% target. We're still looking at close to 3%, but it is down from where it was a couple years prior. And so I'll talk in a moment about what we think is happening in 2026. But the big takeaway here that I want you to highlight is inflation has come down. It's not where it needs to be, but it's probably low enough for the Fed to keep cutting rates, absent a prolonged conflict in the Middle East. If this continues more than, I would say, 2 to 3 more weeks from now, all bets are off, and maybe we're in a very different scenario. But I'm going to talk about our outlook now. We're still basing this outlook on the fact that we think this will be a relatively short-lived conflict. Again, that's certainly up for debate. A few things here. The lighter blue bars, that's what we expect for 2026. The dark blue is 25. And again, we don't need to go into every single number here, but I think what's most important is that, when I think about this year, I think I mentioned earlier, we think it's going to look a lot like 2025. Bumps, volatility, end the year higher. And when you look at the economic data, we actually think a lot of it's going to look pretty similar. On the left, real GDP growth, it'll be a little lower than last year, but it's still going to be positive and in a healthy range. Unemployment rate, little higher than last year, but nothing drastic. And then again, inflation, a little lower than last year, a little higher than what the Fed wants. But these are all kind of okay numbers that suggest modest economic growth, which is supportive of a reasonably good year for stocks, broadly speaking. The other thing I want to highlight, because I get asked this a lot about, well, all the tax cuts that happened last year. The chart on the right, this is a really big one, because this is one of the tailwinds that we're highlighting for why we're so constructive on 2026. When the tax cuts were put into effect last year, the government didn't actually change withholdings. And so if you're a U.S. employee, like many of us, your withholdings were not adjusted for what would be lower taxes that you're going to owe the government. And so refunds that will be coming in the next couple months will be significantly higher. And for the average household, if you're getting $1,000, $2,000 more, that's a lot of money. And most average households, when they get that money in, they spend it. And that's one of the reasons that we actually think you're going to see pretty decent growth in spite of some of the volatility that we're seeing in the market and some of the concerns that people have about things like AI and what that does to the job market. I'm going to skip some of this because we just have a lot here. I think the main thing I would highlight here, when you think about the U.S. economy, the most important thing is that people have jobs. And right now, while you have seen a modest tick up in the unemployment rate, people still have jobs. The chart on the left, payrolls, you saw a bottoming as far as people getting nervous about are they going to start hiring, and it's starting to pick up again, which is a good sign. And the chart on the right just shows you things like layoffs. You can see what happened, some of those other blue lines back during the dot-com bubble, during the global financial crisis, huge spikes in layoffs. We're not seeing anywhere near that. You are seeing kind of a steady range than what we've seen in the last couple of years, but no significant spike. So again, we always worry about a recession. We watch it. And any given year, the odds of a recession are around 14%. We estimate odds this year of a recession around 20%, so slightly higher. But in a world where people in the US still have jobs, they have more money coming in because of taxes and other things like that, wage growth is still increasing, and their balance sheets are still pretty strong, that is a good sign for the macro backdrop. The last thing I would highlight here, again, inflation. We've seen inflation, that's the chart on the left, fall significantly from where it was. Again, still higher than we'd like, but it is falling. And what that means is the most important thing for me as well, the chart on the right. As long as inflation is falling and not spiking meaningfully, you're going to see the Fed continue to cut rates. And the Fed cutting rates is really important because that just makes the economy more flexible for everyone. It helps support growth. It's good for the stock market. It's good for things like housing that have been really locked up because mortgage rates have been so high. If you actually get a couple more cuts, you're going to see mortgage rates come to a more reasonable level, and that means people will be able to afford to move. Right now, people's homes, they have good value in them, but take me, for example, I live in New York. My mortgage rate is 2.5%. So why, even if I want to move, why would I move to another home paying double a mortgage rate when I have a very low rate where I am? I'm going to stay where I am. So if we can see the Fed keep cutting and those rates come down, you'll start to see more economic activity, which could be another potential tailwind. I want to talk a little bit about risks because there are many, and we'll talk about the geopolitical risks and what's happening with this war and what that could mean. But one of the biggest ones when it comes to labor market, at least for the last year, it's been twofold: tariffs and AI. Chart on the left shows you just uncertainty coming from tariffs. So that spike last year, that has come down meaningfully. And I think what we've seen for the administration is while they want to talk a big game, they're pretty unwilling to ride out the negative impact that tariffs have on growth. And so we don't really worry from here about that rhetoric picking up too much. The one that I hear all the time, what about AI? And people are very, very nervous about what it means for jobs. We talk a lot with college students, stuff like that. How do you feel about your outlook? People are scared. What this chart is showing you, a pretty rough way to think about the concerns, but Google searches. How many people are searching, what will AI do to my sector, my industry, my kind of job? And that's causing a lot of consternation. What I will say is we haven't seen it meaningfully impact a broad swath of the job market yet. We certainly do think that's coming over the next 5 to 10 years. And if anyone wants to dig into this more, our investment bank did a really good report of going sector by sector. Where are the sectors that are most at risk? Things like legal, very rote parts, the financial services sector, things like that. And then you have services that are more people-oriented that are not being replaced anytime soon by AI. So we're nervous, we're watching it, but these two things that were the big risks over the last year, I would say have not significantly picked up. And then when you look at what this means, and so, okay, you have some good things as far as economic growth is still looking pretty good. People have jobs, they're still spending money, but there's concerns on geopolitics and tariffs. Well, what's happened? And again, this is all dated. I did this chart earlier this week. The market has moved pretty significantly the last few days. But if you look again at, this is the performance, a repeat of that earlier chart of what happened in 25. What's happened so far this year? Well, again, US equity markets down. The equity markets that are up are the ones in you look at emerging markets, Asia, Japan, and the two big performers, gold and commodities. Again, reflecting this concern that people have. People are worried. They're adding to gold. They're making bets on things like oil because it's a proxy for when people worry about geopolitical risks. And so we're keeping an eye on this. It is not strange a few months into the year to see the market down. And in fact, corrections are pretty normal. What I think is kind of interesting is when you look underneath the hood of the US market, the stock market in particular, you're seeing a rotation. There are sectors that are up and that are doing well. Energy, consumer discretionary, industrials, utilities, materials. Many of these are sectors that people think will be beneficiaries of AI, of infrastructure spend. And then on the flip side, what is trading down? Things that are more cyclical. So parts of financials, technology, as people start to rotate from some of the winners from the past few years and reallocate capital. And I think this is an interesting chart because when I think about the market, I think we're going to see more modest returns this year, call it 6, 7, 8%, something like that in US stocks. But I still think there's going to be pockets where you have a lot of opportunity. And I'm going to talk about that at the end, where you find value and where you could find opportunity in markets. I think the big takeaway for me is tech has been such a huge driver of growth the last few years that you're finally seeing people say, I want to take some chips off the table. I'm going to lock in some gains. I want to start to rotate into other areas. One area that is still down on the year, but I think is pretty interesting, and I'll hit on that soon, is healthcare. I've been getting a lot of questions because historically healthcare, especially biotech and tech, tend to move in tandem. And that completely broke down a few years ago. And we're actually starting to see in the back half of last year, biotech start to pick up again and some momentum in the healthcare space. People always say to me, okay, you have a constructive outlook, but God, look, the market's down, there's so much volatility. I just want to caution you, it is completely normal in any given year to see significant volatility. And what this chart is doing, this goes back to the 80s. What we're saying in any given year, the bars are what the stock market has returned, and the diamonds on the bottom are how big of a drawdown or how big of a sell-off did you get in any one of those years. So literally, you go back 45 years, every single year, you had a drawdown in markets, often between 5 and 10%, which is what we're experiencing right now. And yet, in 75% of those years, you still had the market higher. And so I just like to keep this in context. Like, totally normal to see these bumps, totally normal, and I would argue pretty healthy to see a 5, 10, 12% sell-off. And then it's not that strange to see the market actually rally back before the end of the year. And I'm going to talk a little bit as we move on about midterm elections that are a big deal. But I do want to hit on, this is going to be hard for you to read. These are our outlooks in a nutshell. Big takeaways that I would just say. One rate cut forward from here, we think. You could see more if the economy starts to slow down. The risk to that, of course, is what happens geopolitically. If oil prices stay elevated for a prolonged period, and I mean 1, 2, 3 months, that will be inflationary. It might be hard for the Fed to actually do that one cut. Conversely, if the market sort of stabilizes from here and growth is sort of hanging on where it is, you could see potentially more than one cut. We're still estimating just one. When we look at equities, we think you'll get 7 to 8% year over year. The market has sold off so far, so we're looking for 9 to 10% from where we are now. And then the other big thing that we think will still outperform again this year is gold. And I mention that because it's actually interesting. Again, gold was the best performing asset class the last 3 years. You might say, could I still add to something that's done so well for the last 3 years? I think the best corollary to what we're seeing in gold right now, in the early 2000s, in that decade, gold had a 12-year rally, and it rallied over 500%. I'm not suggesting we're going to see another 300% from here, but I think that's a pretty good analogy to think about, because what happened in the 2000s? You had the dot-com bubble. Many people say that could be similar to what's happening with parts of AI, and is there a bubble there? You had the global financial crisis, big 9/11, big geopolitical things happening. And so there is a context or a scenario where you could imagine why gold could keep rallying over the next few years as people start to diversify away from some of the things like tech that have done really well and want to have a little more safety in their portfolios. So that's our outlook. We think the market's going to go higher. Every time I say that, especially in a time like this, when the world feels a little scary, people are like, what are you talking about? There's so many risks out there. There's a big AI bubble. There's all the geopolitics. I don't even know where to find value. Help me get comfortable. And so I want to hit on some of those concerns, and I'll open up for a few questions if we have time in the end. The AI bubble by far is the biggest question I get. Constantly, I'm asked over and over again, like, how could this not be a bubble? The stocks have run so much. How do you guys get comfortable? And I want to hit on a few of the biggest questions I get and how we got comfortable with it. And again, anyone who wants to nerd out, we have like a 50-page report walking through our outlook that goes really in depth on all these topics I'm going to hit on a pretty high level. The few big takeaways and the way I think about this. So I talked about how well the S&P did the past few years, up 75% over the past 3 years since the lows. What's kind of crazy is if you go back to 2022 when those lows happened, this is the percent of that return. Almost 80% of it came from the 42 AI adjacent stocks. So again, think of like the hyperscalers, things like that. Companies that have exposure. So 75% gains, amazing. The bulk of it coming from there. That might scare you, but what's really important is look at the other couple columns. While a ton of the price return came from these AI stocks, so it's been very concentrated, the bulk of the earnings growth came from there too. And I'm going to talk about that in a moment. And that's like a really big, important thing. And also a really big differentiator versus prior bubbles, where you had price return coming from one sector, but the earnings weren't there to back it up. That is different this time. It makes sense that if all the earnings growth is coming from these 42 stocks, that's where the price return should come to. So the big things I keep hearing over and over again, Monica, valuation's way too high. Why would I pay over 20 times for the S&P? Well, again, valuations are high because these companies are earning a lot of money. Focus on the left. I think the line chart on the right is a little bit hard to follow. But on the left, this is just EPS from the AI ETF. So you look at what happened just a couple years ago to where we are now, earnings growth, a multiple for just these companies of where they were a few years ago. And then, by the way, what you're paying for those earnings has come down, which is what you normally see. You see hyper growth in earnings, valuations come down. That is a normal, healthy thing as the market starts to adjust for what the outlook is for a new sector, like what we're seeing in tech. So yes, multiples are high, but they're high because these companies are earning so much more than they were a few years ago. Well, then people will push back and say, okay, but have expectations gone too far, and is the market too optimistic? The chart on the right, this is just OpenAI. We believe we are like in inning 1 or 2 of a traditional 9-inning ball game when it comes to AI. And the reason for that is, and I've been doing this a long time, trying to forecast expectations. I've been through many big technological shifts, the biggest of which being the dot-com era. People like me are really bad at forecasting 5, 6, 7 years out what a seismic shift will look like. We're really good at saying what's going to happen in 3 months, really bad at 3 to 5 years. And what was interesting to me is this is just OpenAI, the chart on the right. Even OpenAI, from mid-2025 until October, so 3 months, was off by 50% of what they thought their users, their revenue, and a bunch of different important metrics would be. Even the companies have no idea how to quantify this out a few years. So I would just say, doesn't mean we can't be wrong, we might be too over-enthusiastic or too optimistic. Generally speaking, these things happen so quickly, and we're pretty bad at estimating them. My guess is expectations 3, 4, 5 years out are still too low. The other thing I keep hearing is, well, there's been no profitability for companies. Companies are spending a lot of money, but they're still not making anything. I'd say, okay, that's fair, but it's because we're still in the early days. And we're starting to finally see a pickup in the profitability increase. At JP Morgan, we spend a ton of money on tech. We have not yet change the way we're hiring or change the way we're staffing things because we're waiting to make sure everything works well. But you take a very basic part of our business, our client service centers, where people call in, they have an issue. We still have those completely staffed with all the people we always had, but we're seeing AI start to make things more efficient. And this bar chart on the right is one company. It's a logistics company. And they shared in their recent earnings call what the benefit has been from AI. And like us, they have not yet shifted their workforce away from humans to AI, but they're seeing massive increases. So for a traditional client calling in, trying to figure out how long is it going to take and what's it going to cost for me to ship these goods from California to New York, call it, with the human on the phone, it takes 16 minutes to do the quote. With the AI bot or service with their customer, it takes 30 seconds to do the work. So think about the cost savings, the profitability improvement. The other thing, that other bar chart right next to it, it's not just that it's so much faster, they're actually so much more accurate, and that's resulting in flow through to them actually getting orders. So again, the humans complete about 2/3 of the orders that they get involved with. The AI bot, 100% of the orders they were actually completing. So there's a world where you can see in 2-3 years significant increases in profitability in companies and sectors that are going to start utilizing this. We're only still in the early days and we're still getting comfortable. I do want to jump forward because the other big one that I get a lot, because I'm running out of time here, heavy CapEx spending. I hear this all the time. Yes, people are spending a ton more money, and that is a concern if they don't get a return on that investment. I jumped too far. So this is a big one. On the left-hand side here, these are the CapEx spending for the big hyperscalers. Think companies like Google. Yes, it's gone up exponentially. By the way, so have their sales. So I worry a little less if they have sales to back up the CapEx they're spending. And that's been the case really across, whether you look at Amazon, Google, Microsoft, all these companies that are spending more have the cash to spend it because their revenues have gone up in a commensurate way. The other big question I get constantly, well, doesn't this feel like the dot-com bubble? And it certainly does. There are pieces of it that do. The euphoria, the excitement, the big expectations people are baking in. But what I would highlight is, look at the chart on the left. That was Cisco. Back in the dot-com bubble, what you saw was, yes, Cisco's earnings went up. That's the orange line. But look at what happened to the price of their stock. It shot up. There was like euphoria in the market. That's not what's happening right now when you look at these AI companies. The chart on the right shows you NVIDIA, which has also had a hyperbolic stock move. But most importantly, the earnings, that's the orange bar, have far outpaced the growth, what the company's stock has done. So I would actually argue, while you could make a comparison that, these stock price moves can't continue, as long as these companies are earning significantly more, their stock prices should be significantly higher. And that's the difference in what we saw in the dot-com bubble versus now. There's profits, there's revenue, there's real momentum that we think could continue for many years versus this big euphoria that just had a re-rating of companies back in the dot-com bubble. The other thing I would say is, if it is a bubble, and maybe I'm wrong, maybe it is, this is the most hated bubble I've ever seen. You see every day, you see another headline, oh my gosh, the world's going to end, AI is taking over. And when you actually look at sentiment related to tech in general, it is near 30-year lows. That is different from where we were during the dot-com bubble, where everyone was very euphoric. I'm not saying that you can't have a bubble when sentiment is bad, but it's actually quite rare. And I would say people are a lot more cautious, I feel, right now. Again, there's always going to be little things below the surface, that little bubbles that will burst, but we just don't see a widespread euphoric sentiment that makes us nervous about a bubble. And then lastly, I would just want to talk a little bit about leverage. Companies, again, they're spending a lot, they're investing in data centers. But what's really important is we're not seeing them lever up to do this because they're spending from cash flows and what they're generating. And so the chart on the right is, to me, the more important one. In the dot-com bubble, you saw leverage increase 2.5 times for the entire S&P. And you look at where we are now, under 1.5 times. And that's really important. So yes, spending has picked up, but they're not borrowing to do it, which means if things turn and they're wrong, they're not going to be a situation where they can't pay back their debt over time. Last thing I want to make on this AI bubble, we follow what we call YUCs, young unprofitable companies, as another barometer of, is this a bubble? And what young unprofitable companies are, these are companies that come to market kind of on the tail of these booms. So in the case of AI, think of some the crypto adjacent AI companies that IPO'd last couple years, they did well. Well, back in the dot-com bubble, you think of things like Pets.com. In every bubble, and we've gone back and looked at a lot of them, these young companies get a big lift because everyone gets super excited and they say, yes, this is a seismic shift in the market. These companies, anyone who's involved in tech or the internet's going to perform well. The stocks go up and the bubble bursts and they come down. What's been really interesting is in this rally, remember I showed you that 80% of the price return is coming from these AI companies. It's not coming from the young, unprofitable companies that are unproven. It's coming from the companies that have profits, that have revenues, that contracts. And that's a really big deal because the market is differentiating. It's saying, investors are saying, I want to participate in AI, but I'm going to do it with the real companies that have real profits and a real story to them. And they're not investing in these sort of like more questionable, call them fly-by-night sort of companies. And that's a big deal because, again, it makes the likelihood of a bubble significantly lower when expectations and if they come back down to some more moderate level. The last thing I just want to highlight, because I hear this all the time, is and this is just an interesting stat that I thought was kind of interesting. If you look at the amount of tech spending just in 2025 as a percent of GDP, it is almost equivalent to all of these things on the right added up. That's building the entire interstate highway system in the US, getting a man on the moon, the Apollo project, all of electricity built out in the US, and the Manhattan Project. So kind of crazy, the amount that we're spending on this. But I do think it tells you sort of what the market is saying is reasonable when you think about the impact that AI could have on all of us. We'll see if it's TBD, if it's still bigger than all those projects combined. Last one I want to highlight on this. In spite of all the money that's spent, again, look at this. This is showing you debt. So again, how are people financing this spending? They're not financing it with debt. That's the most important thing. That orange line, back in the dot-com bubble, everyone borrowed money for all their investments, and then it crashed. And that's bad. You had a lot of debt, no sales to kind of pay off your debt. Right now, orange line, really low. All of this is being financed by cash on hand and just cash flows that they're generating. So again, another sign that we're not really worried about this bubble bursting. I'm going to skip ahead over these last couple because I think this is the last one that is important. I say broadly, they're not levering up. There are companies that are levering up. What we're showing here are leverage ratios. That dotted line is the S&P average leverage, and the bars are those specific companies. And most of the big ones that people worry about, again, Apple, Salesforce, Google, NVIDIA, they basically have no debt because they still were able to finance everything from cash and from cash flows. But there are companies that have levered up. Oracle, HP, IBM, Dell. So there's a handful that have had to borrow for these investments. This is where, again, we argue that if you're thinking about making an investment in AI, you want to invest more in this trade, this play, you just need to be a little bit more discerning because you don't want to own everyone. If the economy slows down, if this war continues in the Middle East, there will be companies that will be stuck, and I would argue it'll be those on the right-hand side of this page that have had to take on a lot of debt. And if interest rates don't go down and they can't refinance that debt, that might be a problem in a few years. But it is not a problem for the big hyperscalers, the big tech companies. They don't have the debt. And quite frankly, they can handle all the spending they've been making. I do want to talk a little bit about healthcare because the challenge after a 75% rally over the last few years is where do you go? And I've been getting a ton of questions about healthcare because it has been a huge standout laggard over the last couple years. And again, historically, healthcare and tech kind of moved in tandem, and that completely broke down the last few years. And so you had tech run because of AI, and healthcare just didn't participate broadly. Even though when I talk to investors and companies, almost everyone agrees healthcare should be a massive beneficiary from the technology advancements that will come from AI, and yet the stocks wouldn't show you that. So when I think about, is it the time to start investing in healthcare? I always get the pushback of, oh God, Monica, but midterms are coming and aren't elections bad for healthcare? Sometimes yes, but I do want to highlight that's more when you're like on the precipice of something like the Obamacare debate or something like that. That's not happening this time, obviously, with the Republican administration. It's very rare in my world that you can say something always happens, but we went back to the last 15 midterm elections, and every single time, a year later, the market was higher. And in fact, the average return is about 15%, 1.5, after midterms. It sounds kind of crazy. Why is that? Well, because midterm elections generally tend to be a check on whatever administration's in the White House. We think this year will be no exception. And a check in power is a good thing because it means things are at a standstill. initiatives that are too far one way or the other grind to a halt. Market likes that. And so when you think about, again, is now the time to add to the healthcare, or is now the time to add to the market in this dip? I would argue yes. I would use this volatility that we're having now and over the next few months into the summer to start to rotate out of some winners into other areas, because I do expect this trend will hold. I don't know if you'll get the full 15%, but 5, 10, 12 would still be a pretty meaningful rally from where we are. I'll just make a couple more comments on healthcare. I mean, you guys know the healthcare space, but what I would just say, hold on, let me say, I like this slide because there's a couple things that healthcare does really well. It diversifies your portfolio. It has a different kind of revenue characteristics. It's a little more defensive generally than other sectors. And this chart on the left is showing you, traditionally healthcare and tech moved together, and that really broke apart. Starting a few months ago, you started to see people start to go back into healthcare. I think that trend is going to continue through this year and through the midterms, especially because we are coming into a big patent cliff for the large cap pharma companies. And again, historically speaking, when that happens, you see the healthcare sector underperform until the cliff approaches, and then it tends to outperform for a few years after. And that's what we are coming into right now. And we've come out of that period of the healthcare sector underperforming the last couple of years. And as this cliff comes the next couple of years from now, we think you start to see the outperformance from there. The market always gets very worried about the unknown and, oh my gosh, will they ever be able to find new areas of growth? Newsflash, they always do. You'll see consolidation. You'll see big companies buy small companies to make sure they have backfilled their patents that are rolling off. And that's a good thing for both M&A, and I'll end and talk about, we think capital markets are finally starting to pick up again, and also a good thing for the healthcare space in general, because if you own sectors like biotech, some of these smaller companies, if we're right that you see a pickup in M&A, that's a very good thing for that sector. I can't not talk about geopolitics. Generally, we always like to say, ignore it, because in our portfolios, we manage money, trillions of dollars for clients. We do not adjust our portfolios for our geopolitical expectations. Just a bad idea. And the reason is, you tend to see these big blips, and over time, it subsides. That's what we're trying to show in this chart on the left, which is completely insane. You can't read anything from where you're sitting. If you want to dig into it after, we'll send it to you. But generally, what it is you have a blip from a geopolitical spike or shock, and then things always normalize, usually within a few months. On the right, what tends to happen is there's certain sectors that tend to spike the most. Again, things like energy, things like oil, defense stocks. I would expect that to continue this time. But again, we don't tend to trade around that. If you are a day trader, I'm happy to share some of these ideas with you of how to play this over the next few months. But most importantly, you just shouldn't let the headlines and these fears, don't let the tail wag the dog, as we say, because in almost every time period, it literally does not matter. So if you look at the chart, the bar charts on the left are showing you, we looked back and we said, let's go back and look at all these geopolitical shocks over the last, I think we went back the last, 30 years or so. And we said in all these shocks, if you waited to buy from after the shock, or you just did it at the recent all-time high, what was the difference in your performance? And in almost every case, what you can see, your performance is almost the same, because the shocks happen and then things normalize. So not a whole lot of value to try to time things. If you're trying to put money to work, quite frankly, I wouldn't wait. Chart on the right just shows you general investing, just when you think about stocks, again, over 3, 6, and 12-month periods. So this is maybe a little more applicable to someone who's like, I'm buying a home next year, or I have some kids going to college, I need my money. Within a 3-month period, timing matters. So if you are a day trader or you have some sort of capital that needs to go out the next few months, absolutely, maybe now is not the right time to put money to work. But any sustained period of time, it literally does not matter if you wait for the perfect day or just buy at a high. So I show this to all my clients who fancy themselves active traders. Maybe they do slightly better in a few-month time period, but it generally does not matter over any sustained time period, whether you buy at the high or you wait for a day like today when people are worried about what's happening in the Middle East. The one thing I do worry about, and we've done a lot of work about this, and this is like a longer-term question, and goes back to the question around U.S. debt, U.S. exceptionalism. Can the U.S. kind of maintain its role in the global world order? And part of the reason, if you think back to the beginning of my presentation, I showed that the U.S., in spite of having a great year last year, was the worst performing developed market in the world. it was because of this trend. And I'm not making a call about politics, right or left. What we tried to look at over the next few slides was say, what happens when populism, right-wing or left-wing, takes over historically? And we went back a couple hundred years, which we obviously don't have stock market performance for a couple hundred years, but we looked at a variety of metrics. And under any metric we looked at, extremism, right-hand or left side, was bad for markets and bad for the underlying economy. And I say this because I showed that chart. Why would the market rally if there's a moderation at the midterms? The market's rallying because it's getting more comfortable that extremism, again, on either side, will be muted. And we looked at a few different metrics. We looked at things like freedom of elections, freedom of media tends to go down when populism sinks in. And what we're showing here in this chart is we're showing months after a populism regime takes over. Things go down. Not good. What happens to the economy? You tend to see things like tariffs pick up, GDP, financial openness go down. That's bad because people don't want to invest into those financial markets. That's part of the reason last year you've seen the dollar weaken. You've seen people start to buy things like gold, start to look for other safe haven assets. The other big thing that's important, populism is generally bad for inflation. Because you do things like tariffs, you close your economy, things get more expensive. And so again, if we weren't to see a moderation in the midterms, this could be another sign that perhaps inflation would pick up. And then, of course, GDP growth. So you kind of have like the worst of all worlds, which is why, generally speaking, if you're in my seat, we kind of hate the idea of extremism. We don't want it because it means lower growth, higher tariffs, higher inflation, and generally lower stock markets. I'll talk about one other risk. So for me, one of the big risks, obviously this war ongoing. If we don't see a moderation in the midterms, I think that'd be bad generally for all the reasons I just talked about. And then I hate to go from like one potential war to another, but we're all focused in the Middle East. The biggest risk that we see out there that still remains is a potential invasion into Taiwan from China. And we got a couple slides here that show you why this is such a big deal. They don't have to invade Taiwan for this to become a very big deal. All they have to do is blockade, which they're kind of already positioned to do, and just sort of need to creep a little further, and it would have massive implications on the growth outlook and just what's happening around the world. Taiwan, as we say in this headline, one of the most blockade-sensitive countries in the world. This is net imports of fossil fuels, almost 90% coming from outside of Taiwan. In a blockade scenario, we estimate they could go about 3 weeks before they have energy issues because of how much is imported. That's really bad. Same thing when you think about food, their domestic food supply, almost 70% for Taiwan coming from outside of the country. So again, a blockade is all it takes to cause a food crisis, which would be really bad. Then you say, okay, well, how quickly could this happen? What we're showing here, the percent of Chinese military assets that are currently in the strait around Taiwan and already in position to potentially do a blockade. You can see a very significant amount of their amphibious assets and other parts of their military are ready to go. Doesn't mean they're going to do something, but this is, in my opinion, the biggest risk that now, because of everything happening in the Middle East, people have started to stop talking about. And then, of course, it's a big deal, not just for if you live in Taiwan, it'd be pretty bad. It's a big deal for all of us. We talked after the Ukraine, Russia conflict, which is still ongoing, how crazy was Europe to rely on Russian natural gas. Well, this chart on the left, this is showing you the European reliance on Russian natural gas. It's only about 20%. But look at the blue bars are showing you global semiconductor reliance on Taiwan, 60%. Global reliance just on like advanced chips in general, 80%. So again, a blockade in Taiwan, huge implications for how we all do business and conduct ourselves. God, I hate to end on like a negative note. What do you do? There's a lot of scary things out there. I did just say don't panic. I wouldn't rotate your portfolio out of everything. Don't go sit in cash. But there are things that historically do tend to do better in times of stress. Gold, I mentioned in the beginning, already had a huge rally the last few years. We actually think that could continue for a number of reasons. And this ongoing conflict in the Middle East and potential concerns about Taiwan is another area. I have clients all the time, they say, I'll just buy treasuries. Treasuries are actually generally not a very good protector in a time of stress. You tend to see better outcome from owning things like oil or gold. Gold is my preferred asset to own right now. I do want to just jump ahead because the other thing, I always like to show this Gaia. The other thing to think about if you're like, how do I insulate my portfolio from risks? You want to do things that are going to protect against the risk that you're not thinking of. This is a picture of a plane from World War II. I don't know if you guys know this anecdote, but back during World War II, the US spent a lot of time trying to figure out how do we make our planes stronger. They looked at all the planes that were coming back from the war and where they were shot up and said, okay, we need to spend a lot of time and make sure we reinforce the wings, reinforce the middle of the plane, reinforce the tail of the plane, because this is where we're getting shot. The problem with that strategy is it's called survivorship bias. We were looking at the planes that made it back. We weren't looking at the ones that were shot down and didn't make it back. And the reason they were shot down is they were getting shot by the propeller in the front of the plane. So we actually should have been reinforcing there, not the parts that actually had survived. And so I highlight that because this is the big mistake people make in their portfolio. Like, we're always focused on the risks that are on the top of our mind, and right now that would be obviously what's happening in the Middle East. Maybe a little less focused on, again, what would happen in a Taiwan flare-up situation. What would happen if inflation doesn't keep going down? And what this chart is, and I realize it's hard for you all to read, this is one of my favorites, because when I talk with families and companies and investors, I say, like, you got to figure out where is the risk to your business, to your portfolio, to your personal life, and do you have enough that performs well in those scenarios? And the point of this slide is everything serves a different purpose. You know, if you're, I like to focus, because this is where I think the biggest risks are for most people, is the right-hand side of this. Most people are not positioned right now for a world where inflation keeps going higher. Most people assume the Fed could keep cutting rates. Most people assume, growth is okay. And so things like infrastructure, real estate, loans, hedge funds, these are the kind of things in a portfolio that do really well in that environment where inflation keeps ticking higher, which I think is one of the biggest underappreciated risks. And it's also, coincidentally, we looked at all the 700 large families that I work with, very smart, very sophisticated people. Those things in that circle on the right-hand side are where they all consistently have the lowest exposure in their portfolios today. So I mention this because we got really smart people who do this for a living, and yet they still have big gaps in their portfolio. They're missing where the risk is. Where are they most susceptible? Where in that plain picture are they not taking into account things that may not pan out? And so I just say this because there is always something else to do. That's my job. I'm happy to talk to anybody after. And my partners, Glade and Ryan, if you want to look at any of these slides or have follow-up questions, we're happy to circle back with you from JP Morgan and answer any questions that you guys have. I don't want to, it's funny because there's always something to do in markets. I want to reiterate my view, though, as we're wrapping up here, and I got a couple minutes left and wanted to take a question or two if anyone had any. Take away the big picture. We remain constructive. I actually still think, in spite of all this noise, the market ends the year higher, especially from everything we talked about, stable job market, tailwinds from things like tax refunds, and the fact that I think we'll get some moderation in some of the rhetoric from the administration post-midterms. But that doesn't mean you shouldn't be doing something. We should all be kind of taking stock of where have we done really well the last few years, because if you own stocks, you've done really well. Where should I rotate a little bit? Where are those risks that I'm not appreciating? Always something to do. I remain optimistic. I'm glad to be back out here. I do have 1 minute left. I want to keep on time. Does anyone have a burning question? Otherwise, I'll scurry back off stage and try to grab some of you later. And I can't see at all if anyone's raising their hand. So if anyone has a question, just shout. Otherwise, I will say thank you. Oh, I see a hand, I think. I think they're going to get a mic over.
Do you think NVIDIA and AMD will continue to have the massive growth they've had throughout the past year?
I think it's going to moderate. So I think it will be slower than it was. By the way, I own NVIDIA. We own them in portfolios. Our tech portfolio managers still own them in portfolios as well. So I think they're still important stocks to own. Semis in general, good trade. I just think we have to be realistic that after a move like that, you probably do see some moderation. So what I've been having some of my clients do, again, if you've done so well in these names, we call it portfolio drift. Do you need to own as much as you do now? You probably own more than you ever thought you would. So I would take some off. And that's where I would look at some of these other areas, like what hasn't benefited yet from this big AI boom. And that's where I go back to, again, healthcare, industrials. Like, where are we going to spend money to keep supporting this infrastructure? I might take some of that money and rotate a little bit there, but I don't think I would sell out entirely. I have 7 seconds left. The hook's going to come. Listen, thank you all. We're happy to, again, answer any questions that you guys have after. I appreciate the time. I'll see you next year.